when the market's confused. Steve strolls in with a chart and some probable news. Troy fires up Omega like, let's model this mess, while traders at home whisper, please help me stress test. It's the show where the candles dance. Volatility takes its chance. Steve says rules, Troy says math. Together they chart a hilarious path. Grab your lunch, don't be late. They'll tell you why the market's weird again. Oh, great. They're calling out levels, volatility rebels, equity drama, and index devils. One guy's calm, the other's pressing buttons fast. Is this bullish? Is this bearish? Ah, depends on the past. So tune in, laugh, and maybe learn too. These two make the chaos look almost doable for you. Every Tuesday at noon, hit that stream real quick, because markets are wild, and these two are slick.
Steve, how the heck are you?
Good, good, good. Happy March 10th.
March 10th. It's daylight savings. We stay
March
up late
Madness.
now. March Madness. When does that start?
I'm actually going down to the Big 12 tournament, which is held here in Kansas City. I'm going to that on Thursday. So I think it's actually the conference tournaments are going on right now, and then the big dance starts here in a couple weeks, I believe.
Okay. Yeah, it's always like the end of March. I forget. So, Steve, how's the market? We've turned Iran news into good news. Just every Iran news now is.
Well, the war is over yesterday. It ended.
War's
You didn't hear?
over. Yeah, war's over. It was fun while it lasted. It's all good. So,
yesterday was a little bit challenging because I had some positions on that kind of got smoked a little bit on that explosion higher. I actually paused my British Iron Condors, which I think was good early because I probably would have had some double stops, but that explosion higher, I only had one tranche on, and my calls, that I bought it like my long call part of the Iron Condor, which I bought it, I think 30 or 40 cents, I ended up getting out of for like $5.50, and they went as high as $15. So those kind of moves can be good for those. But I just had one on at that point. And then I had a double calendar on. They got pushed way out of range, and prices were jumping all over the place. So I got hit a little bit on that move today. Not bad. I had 3 day trades this morning. Actually, technically 2. I had one in Tesla, which was long, and one in Nvidia, which was long. I actually had 2 trades in Nvidia, but I I meant to buy 40 call option contracts, and I accidentally bought 40 shares. So I ended up booking $6.91 on that.
Yeah, you did. How does Daddy do it? That's the question. Yeah.
So a few good day trades, and then I'm working some DC time machines, and I didn't do a 1 DTE today with the big vol contraction overnight. So that's about it for me today so far.
Yeah. I'm pretty light today. I exited most of my stuff yesterday and just kind of resetting. Yesterday felt like a reset day a little bit for me.
Yeah.
So borrow more money from the bank, refinance the house, just reload up, as you do.
Got to do that. I'm in the middle of a reset myself, Troy. I'm doing a bone broth fast as we speak. I'm about 30 hours in right now.
You look great.
Thank you.
You look great.
My skin looks good.
I have a habit where I'll say, hey, I'm really going to eat healthy. I really got to make some changes in my life. Oh, there's pizza. And then I just eat the pizza. So
yeah.
Bone broth's delicious, though. Speaking of bone broth, what would you consider the bone broth of a trade?
Wow.
That's
what a transition.
The worst transition ever. Steve, you wanted to talk about pairs trading today, and I was really excited about that because I love pairs trading, and I go back and forth in my mind sometimes to say I I really think sometimes like that's all I want to do is pairs trade. When it's hitting, it feels like the most fun thing to me. So I was excited for that. How do you pairs trade? How do you think through it?
Well, I mean, I don't do a lot of it, and I used to do a lot of it, but I mean, I've done things as basic as buying Russell futures and shorting Nasdaq futures on a specific combination where the notional value is fairly similar, and just trying to catch the spread between the strongest and the weakest indice that day, that kind of stuff. I've done a lot of that in the past. What I wanted to chat about today, and this is something that I haven't really even talked about in my community, and because I haven't really figured out the mechanics exactly of what I want to do, but essentially, kind of high level, and then I'll share my screen and kind of show you what I put on today. Um, but basically, the concept is this: uh, in periods of volatility spikes, and so ideally, the time to enter these, from where I've had success doing these, and I kind of thought about it after the fact, so I just entered it today, which is not necessarily ideal, but the concept is when you get a big volatility spike, the time to enter would have been Friday afternoon or even Monday morning. When things are going crazy, the world's coming to an end, that kind of situation is, in my opinion, the best time to enter this. And essentially what I'm doing is I'm buying puts in VXX, and simultaneously buying an out of the money put spread in SPX. So on my screen, what you'll see here is the put spread in SPX. And so in this case, I did two lots. Uh, Strikes are 35 wide, a little bit out of the money. So you can see my max loss if S&P goes up is a little over 2,000. Max profit, if we expired below 67.40, max profit would be about almost 5,000. So over 2 to 1. And then on the, and so two contracts in SPX versus 10 puts in VXX. Same expiration. In this case, I did 38 days out, which I don't plan to hold it to expiration, but that was just kind of the expiration that I chose. So the idea here is if volatility continues to contract, obviously the VXX puts are going to make money. And if we get back down into a normal volatility range, let's say I could make $3,000 on the VXX puts. Conversely, if volatility is contracting, most likely the S&P is moving higher, so I would lose on that one. So I'd lose 2,000, make 3,000 is kind of the concept behind it.
I love it. I love it. And how often would you do that? Like you might have just said this, but when would you plan on something like this?
Yeah, so I put this on today, which I don't think is the ideal time, but I was looking at volatility charts and just thinking, okay, a lot of times once you see this kind of blow off top volatility spike, a lot of times it really just continues to keep contracting back down to kind of normal levels. So ideally, this would have been put on Friday or Monday, when, like I said, when it seems like the world's coming to an end and volatility just spiking like crazy. That's really the time that you want to put it in, because say if you put this on Friday afternoon, and I'm not going to say trying to get in at the tippy top, because that's nearly impossible, but let's say you got in Friday afternoon, we had another spike Monday morning, but then the massive reversal, and so VXX at that time was trading at nearly 36, and it's already back down to 31.
Yeah.
So your VXX, the puts, let's say from 36 to 31, I would already be up a couple $1,000s on those puts. And then, the SPX, if I would have done a similar spread in SPX, I would maybe be down 500, 800, maybe $1,000. So even there, you've got $1,000 spread of profit versus loss that you could, take off whenever you kind of think it's maybe done a little bit.
Have you looked at the VXX? It's call skew, right? Because of the vol the nature of it. It's more call skew than
Right.
put skew. Have you um, have you ever done that and kind of not got the returns you've got because you were just doing the long instead of like doing a spread down there? Or have you felt like that crush is so heavy that you kind of overpower it with the deltas you're getting to the short side?
Typically, the crush it dominates, and so I kind of err on when I'm position sizing them and trying to size one versus the other. I'm definitely erring to the side of the vol crush, which would be the VXX puts in this case. I don't know if
Yeah,
I answered your question,
it
but
wasn't a great question. So I mean, I've looked at that before. One of my trades that I do, and it's never enough. I always wish I did it more. And I probably, you're giving me the idea to maybe pursue it even simpler times. But like, I've got so many puts in various vehicles. Like, I've got SPX Qs, I got VIX calls, I've got all this stuff. Well, when VIX gets to 30, you think, well, you're just going to monetize it. But there's always the promise of VIX 60, right? And
right,
so one of the things I'll do to start kind of uh, gamma hedging a little bit against that is short the front month vol future, and I'll buy the back month vol future because we're in backwardation during those times,
right.
and so I'll do that as a hedge. I wonder if you could do something like that as a proxy instead of the VXX puts of just shorting volatility via those future spreads and then taking that XPX position. It's one half.
That way you don't have the premium decay of the long puts.
That would be the only thing, yeah, is to
Yeah,
But you also have to size up more because you also don't get the gamma of that.
right.
It's like static deltas, and so um, that would be something that's interesting. Have you done any other type of pairs trading before?
I was just checking the yeah. So let's see. I was just checking the VX the volatility futures in TOS. Looks like it's going to use about $20,000 of.
Yeah, VXM. You can do VXM as the micro
Oh, okay.
to get.
I have not used that. I guess the reason I kind of gravitated, and then I kind of gravitated to the limited risk. So if I put it on and then we did get a really bad volatility spike, I had that defined risk component to it. Whereas the futures, you're a little bit more.
Yes.
I don't
Yeah,
really
that's
like
why.
to short volatility futures.
Well, I agree. I've never done it when I'm massively oversized long vol as opposed to this. So I only ever use it as a hedge against or to lock in profit on particularly like the overnight move. I mean, Steve, it was brutal Sunday night because the futures, when we're down 170, my vol was really starting to kick in, and so VIX prices overnight were really, really advantageous to me. And so you try to lock in as much as you can. But to your point, I'm very fearful of shorting vol
Right.
in general. And
it could be that one time.
It could be that one time.
Yeah.
And it's kind of a dangerous game. And I know people do this. People do that trade all the time where they short the front month and buy the back month. I don't like to do that when you're not in backwardation.
Right.
It just feels foolish to me. But I like the way you're doing it because you are capped using those puts. So have you ever done any like Qs pairs to or equities pairs?
Yeah. I mean, I used to do, yeah. I mean, like, I don't remember. It's been a long time, but I would do like Walmart versus Target kind of things. I would do Lowe's versus Home Depot type things. And really, really what I was the only thing that I was doing was really just waiting, I'd chart both of them and just kind of wait for kind of a break one or the other, and I'd be shorting the stronger one and buying the weaker one just to see, just until they kind of came back, kind of reversion to the mean back together. But yeah, and then the futures was really my favorite. Just kind of buying Russell versus shorting
Yeah.
Nasdaq, things like that. And
Yeah.
it was one of those things that just kind of got cut because I had to scale back on my capacity of different
Yeah.
strategies that I traded. But I still like pairs trading a lot. It's just something that I haven't really been focused on because I've been so focused on other stuff.
I'm going to work on a study. I've been working on it. I'm going to try to put it out, a study, like a white paper. I'm going to talk about it on a show. Maybe we talk about next Tuesday. Actually, if that's all right, I'm going to just say that's what I can do. I have a study basically. Next Tuesday, we'll look at it where it's looking at if the Qs open up buying SPX premium or selling put spreads or selling premium against it to the upside. Basically going long SPX when the Q is up, independent of the S&P.
So if the Qs gap up, you start selling put spreads in SPX kind of thing.
Yep. Yep.
Okay.
Because SPX is so driven by the Qs that on any given day, the Rust might drag it down, but the NASDAQ's going to lead the market.
Yeah, the Russell can march to the beat of its own drum a lot of times.
Russell is its own kind of animal, but you can do similar things where it's like maybe as a hedge against that strategy, you actually buy put spreads in IWM and adding that to the portfolio and looking at that to where you're kind of like you're long overall market, but you have a hedge if we drag down,
Yeah.
But maybe we'll look at that next Tuesday.
The other thing that I just anecdotally always look at and kind of notice is that because the Russell is full of a lot of small regional banks, and so it's a little bit of a proxy for banks or financials. And so on my board, I have one board that's all financials, and I have like the big banks, which are not part of the Russell, but JP Morgan, Goldman Sachs, Bank of America, and then looking at the Russell too, there's always a pretty decent correlation between them. And so I haven't done anything, but something I've been meaning to do is kind of look at a little bit of a mechanical, systematic way of kind of doing a pairs trade against, let's say pick one of the banks, let's say JP Morgan, and then, doing a pairs trade with the Russell to kind of hedge off that exposure too. Like I said, I haven't figured out what that would be yet, but something I've been kind of thinking about.
I love it. Well, that'll be fun. I'll plan on doing that next week, and I'll share them ahead of time, of course, to where I'm not blindsiding you. Although that is my favorite thing to do with guests is just completely blindside them with things. So
I like free flowing sometimes.
Oh yeah. Well, Steve, this is the joy of doing the show with you. Is I'm going to call it now so that I can ask you off the market mentor question that no one else gets to hear, and so that's the joy of doing these shows. So, what's final prediction? Do you think vol? I mean, we've had 2 days of pretty big mean reversion. Do you think we stay above 20, or do you think we continue this kind of VIX down?
I think we crush. I think we continue to crush. I think maybe we do chop around 20, 20 to 22 the rest of this week. But I think I think we continue to crush next week. I think a lot of times just what I see or feel or observe, no statistical data to back this up, but it's just like once the kind of the news comes out. Yesterday it was the war's over, even though it's not over. It's kind of the uncertainty has peaked.
That's right.
And so it's just like at that point, it's really hard for volatility to start spiking again, unless some crazy surprise comes out, which it certainly could. It certainly could. But barring any, crazy surprise, even, it's like a lot of times when it comes to this, even you'll start even hearing stuff that you think should be crazy that should spike vol, but vol continues to contract because it can't stay up that long.
It's a thing that's always interesting talking to people who are not traders, because they'll say, the war is really going to cause the stock market to drop. Like, we'll tell the market that during the Iraq war that went on forever, as markets just went to all-time high after all-time high pre-2007. Everything's always front running, and like once the data, so you're getting terrible news right now. I mean, Iran's like doing cluster missiles into Israel. It's like market does not care. We've already priced it in. Everything's priced in. We're good. So now we're just trying to price in our own gains, Steve. On that note, listen, have a good rest of the day. I know you're going to be doing some DCs, probably looking at some stuff if it comes on. And what else is going on the rest of the week for you?
That's it. We got CPI tomorrow morning.
Oh yeah,
pre-market. So maybe out, and that's the other reason I went ahead and put that volatility pairs trade on, is because I think, again, assuming it's not a crazy surprise, volatility will get crushed again after the CPI data comes out. And then we've got FOMC next week, which will cause even more crush, most likely.
Yep.
So that's part of my thoughts behind what you just asked, is do I think volatility is going to kind of stay bid? I think after those two events come out, and barring no crazy surprises with Iran, I think we just continue to crush below 20 again.
VIX 15, here we come. Steve called it. So, all right, boys and girls.